Canadian Investor Scores: How to properly insure your mortgage. Terms of use and disclaimer. The content of all videos or articles produced by the Financial Literacy Learning Center are for educational purposes only. All ideas, opinions, and a forecast are for information purposes only and should not be construed as a recommendation to invest, trade, and or speculate in the markets. We believe in the use of an investment professional before investing. Not all advisors are alike. We can assist you in matching advisors with what you may be looking for. We strongly believe that the majority of investors require assistance from an investment professional. We hope you view our video on the investment industry to become fully aware of all types of various licensed investment professionals in Canada, along with their fees and our compensations as well as their services. Here's a young family that just bought their very first house. Wow, they finally did it. Now let's get that mortgage finalized. They go to a bank and they say, I would like an all-natural, hypoallergenic, gluten-free mortgage with a low carbon footprint prepared with a recycled soy ink in a peanut-safe environment. Now that's funny. But what actually happens is, you walk into a bank or mortgage broker office and they may say, when you die, do you want this mortgage paid off? You say, of course. Well, this concept makes total sense, but what you may not make sense to you is how you do it. You got a mortgage, want to do what is right for your family and save money too? Mortgage insurance versus term life insurance. So many forms to finalize the mortgage, and then comes the insurance form. Don't sign it. I'm sure you know the penalty for reading the fine print. Don't worry, just initial it. Take your time, relax, and we are going to help you do your homework. You're not required to purchase the insurance from a lending institution. In fact, it's illegal for a financial institution to insist that you enter into a specific financial transaction, such as buying debt insurance from them, as a condition of some other transactions, such as getting your mortgage application approved. Section 459.1 of the Bank Act. Read this law very carefully and don't be intimidated. Read the second paragraph in particular. It says, for example, if you apply for a mortgage at a bank, the institution cannot make you buy another product or service as a condition for obtaining the mortgage. It's as simple as that. Now let's get serious and simply compare these two financial products and give a real life example. Now, you would question, why get involved with all of this? There are two reasons. First, it's smart to have insurance covering your mortgage because it protects your investment if you die. It gives you and your family peace of mind. And second, first-time home buyers are already up to their eyeballs in decisions. Everything is new. So much to do and think about. Budget is super tight in many cases. But after all of that, you want to protect your home and your investment. Yes, I already know this. So what is the right way to insure mortgage debt? There are two ways. A, financial institution and mortgage brokers can sell mortgage insurance, mortgage life insurance, and creditor insurance. And B, you can buy term life insurance for the amount of mortgage from an insurance broker or agent. Either way, your mortgage is paid off if you die. There are very big differences between these two options though. One really big difference being a potential saving of thousands of dollars through the life of the mortgage, and definite, a true peace of mind. Mortgage or creditor insurance. Policies purchased when you sign your mortgage papers. It's offered by the bank and typically involves answering a few questions. It's very convenient, but it comes at a cost. This policy involves post-claim underwriting. Even though you're paying premiums, you're not necessarily covered. Insurance companies will delve into your medical history after the claim is made, which means at death. If you have a health condition when you sign the papers, whether you or your doctor are not aware of this and it's not disclosed, your claim may very well be denied. Your premiums always stay the same, but the amount of insurance coverage decline as you pay down the mortgage. Coverage only pays for what is left on the mortgage. Again, you're paying for a larger payout that is not there. The death benefit goes to the bank, not your family. The bank is the only beneficiary. Everyone pays the same premium. There are no discounts for, say, being a non-smoker or being healthy or being a woman who statistically live longer than men. You won't get a deal. You may be paying for someone else. There is no portability. Your policy is tied to your bank's mortgage. If you buy another home or if you switch to another mortgage because you find a better deal, you have to apply all over again. Now you're older and hope your health is okay. Higher premiums will result. In most cases, this form of non-underwritten insurance is very expensive. We have a case example at the end of this lesson. Seller at the institution gets a salary and may get extra bonuses for selling this product. It's a very lucrative product. Bonuses are usually based on quota. And term life insurance is underwritten. You must first qualify. Most likely you answer a series of questions and a nurse will visit you to determine if you qualify. This process is less convenient, but once you qualify or underwritten, then there is no denying a death. The premiums will reflect you. You won't be paying for a chain smoker too. There is no declining final benefit. If your mortgage was $500,000 in the beginning, your estate will receive $500,000 at death, tax-free, no less. The bank does not receive the insurance payout. Your beneficiaries do, and they will determine to pay out the mortgage or not. Your insurance advisor do a needs analysis. If you already have insurance, you may not need more for the mortgage, or maybe you only need a partial amount more. Your mortgage lender will not bother with this and always covers the full amount, whether you need it or not. They can't do a needs analysis like licensed insurance professionals. Whether you own term insurance, you can consolidate all the insurance needs like mortgage insurance, income replacement, etc. Not a single policy, and you save on fees. Mortgage life insurance is tied to your mortgage. A simple term life policy will be portable and continue to cover you regardless of who you have a mortgage with. You can take advantage of better mortgage deals elsewhere with no worries having to pay higher premiums. Term life seller receives commissions or salary bonus for selling the product. Mortgage life insurance is underwritten after the death. This gives the insurers greater ability to find a way to disallow the claim at a time when you're no longer around. And there's nobody that could fight for your claim because you have gone. The real life insurance policy is underwritten before they let you buy it. That makes total sense, and it's very simple. If you die, it pays premium. A real life example. I chose a Canadian financial institution and presented parameters and data on a proposed mortgage and then looked for an alternative. We generally feel that when it comes to mortgages, most banks are the same over the long run. We're not trying on focusing on any particular bank, just that this example reflects the bulk of the industry. Here's a young couple, Joseph and Ingrid Doe. They bought a house in Oakville, Ontario. Both are around age 40. They sold their house in Mississauga and moved to Oakville. The house cost $900,000 and they placed a $400,000 down payment. They require $500,000 of mortgage. Joe and Ingrid chose the local branch of one of the big 5 banks for their mortgage. Now, here is the mortgage terms at the bank. Quote date is December 12, 2016. Loan amount is $500,000. Amortization for 25 years. Term is 5 years. Loan will be paid off after 25 years with scheduled payments. Interest rate is 3%. Payment is $2,366 and change monthly. Balance at the end of 5 years is $427,372.90. And here's the payment schedule. The mortgage payment comes out to be $2,366 and change monthly for 25 years. Your mortgage has a rate of 3%. These results assume that the interest rates does not change during the amortization period. Mortgage seller insurance product code. Big bank mortgage or creditor insurance code. Both couples are healthy and non-smokers. Both are age 40. This is a form of first to die insurance, which means if one of the couples die, the remaining principal left on the mortgage is paid to the bank. Monthly payment code is $183.60. On an annual basis, it comes out to be $2,203.20. Payment does not decline with principal owed. If one person dies after 5 years, even though the payment is based on $500,000, the payment to the bank, if everything is okay, will be $427,372 and change. Now that's a difference of $72,627.10. Quote date was December 12, 2016. Now I discovered exciting news doing this exercise. Big Bank owns an insurance company called Big Bank Insurance. I went there for 25 years term quote. Now here are my findings. The first thing's, why wasn't I told about this big bank division? The law separates insurance companies and banks. Big employee cannot refer you to its own big bank insurance arm. Big Bank has a second division that sells insurance products too. Wow, 2 alternative choices with the same bank. What a great company. Turns out that most banks own an insurance division too. I sat with a licensed insurance agent with a big bank for advice. I asked for a quote on $500,000 joint first to die 25-year term policy. A policy that is first underwritten for $500,000, 25-year term cost $117.72 monthly or $1,412.64. Rate will not change for 25 years. You can stop payments and cancel this anytime. And when a spouse dies, the beneficiaries, not the bank, will receive $500,000 absolutely tax-free, no matter what the principal left. The insurance life agent that interviewed me began to ask questions and came up with another solution that never occurred to me. Amazing. I didn't know. Now, why not get 2 separate insurance policies? The insurance advisor indicated that based on the cost quoted at the bank, it would make more sense to hold 2 separate 25-year term policies. He proceeded to give me the 2 quotes. He proceeded to give me the 2 quotes. I was expecting a large number, but I was surprised at the result. Joseph Doe, age 40, a non-smoker, would pay $74.10 per month, or $889.20 per year. This was for $500,000. If Joseph dies before the 25 years is up and the policy is in force. Ingrid Doe only pays $53.15 per month, or $637.80 per year. Why lower? Well, women live longer, so they pay less. Combined, both payments are $127.25 per month, or $1,537 per year. Now, they each have $500,000 policy. If they both die within 25 years, the beneficiaries get $1 million for a monthly payment less than the smaller policy with the bank. What a huge difference. The advisor also indicated that these policies can be convertible, meaning that Joseph and Ingrid can extend their term up to 25 years beyond that to term age 100, at which time the policy will be paid up. Don't need another underwriting. Premiums increase as you get older and extend term. Great feature. The advisor indicated that we do an insurance needs analysis to make sure all insurance needs are covered. He told me that if I give them the car and home insurance business, provided I like the deal, the 25-year term quotes will be reduced. Wow, more savings. A banker or mortgage broker is not licensed to do this. Let's do a recap. On the joint first to die insurance, the bank product costs $2,203.20 per year. The term insurance offered by the same bank-owned firm cost $1,412.64 per year, a savings of $790.56 per year. What can your family do with an extra $790 for a better product coverage? Over 25 years, you save almost $20,000. Surprisingly, you can get double the coverage, which means $1 million for a savings of $676.20 per year, or at least $17,000 over 25 years. So here are our conclusions. Based on this real life, no pun intended example, the obvious choice is to go with the 2 individual $500,000 25-year term policies. Get the home and auto quotes and get much more in savings. These are very large, serious savings. Ask what your friends and relatives what they are doing. Maybe they have already done this exercise. How should a consumer approach this? Follow these steps. Find the house you want to buy. Go to big bank or mortgage broker and find out the size of mortgage you qualify for and its terms. The topic of mortgage or creditor insurance may not come up at this meeting. Buy the house, congratulations. Go to the big bank insurance office or an insurance broker first for analysis to insure the mortgage. Get a quote. And then go to the big bank to finalize the mortgage application forms. It is at this time that you are presented with the sign the mortgage insurance form. Insurance will be blended into monthly mortgage payments. Compare this with the other insurance product quote you obtained before this meeting. If the term quote was better, then ask to sign an insurance waiver form when signing the mortgage application. Indicate to the big bank mortgage representative that you are going to the insurance division to get term insurance for the mortgage. Ask for the address of big bank's insurance division. They would be more than happy that you explore this route. Remember, the law indicates that they cannot refer you to the big bank mortgage arm. You must ask them. Be very suspect if the big bank or mortgage broker representative discourages you to go to the term insurance route. Term insurance at Big Bank Insurance Advisor involves underwriting where a medical is required. A nurse will go to your home at no cost and will ask a series of questions and do the test. Enjoy the extra dollars saved and have a peace of mind. Saving money and better peace of mind, all due to a little bit of education. What if you already have a mortgage and have the big bank mortgage insurance? Number one, you should insure your mortgage. It's about what is best for your family. In the majority of cases, it's much better to get a term insurance to insure the mortgage to accomplish this. Remember, look at this from a 15 to 25 year perspective. Go to Big Bank's insurance advisor and get a quote on a term insurance policy. Look back at our real life quote exercise. If the quote is better than what you are paying now, then sign up and then ask the advisor to give you a form letter that you will give to your bank to cancel the current mortgage insurance that you currently have. This does not affect your mortgage. It's done all the time. Ask Big Insurance Advisor for a home and auto quote and see if you can get a big discount on term insurance premium. A banker can do this. They don't have life insurance licenses. Want another perspective? CBC Marketplace did a great investigative report on mortgage insurance. You really have to see this on YouTube. I've got the link here if you want to watch. Spread the news and tell people about this educational site, please, if you enjoyed this, and I'm sure you did. Tip: put your extra savings in your child's or children's RESP and get another government grant towards their college or university education. Look at another of our lessons to learn about what an RESP is. Here's a sample of mortgage insurance waiver form that you can sign at the time of signing your mortgage application. And ask for our help. Go to www.trustedwealthprofessionals.com and enter your postal code in the Wealth Professional locator to find someone in your area that can help you. Or click on Contact to inquire. We'll get back to you. Feel free to review other investment lessons within the CIC sessions and sign up for the Golden Swan, a free educational newsletter. Thank you for watching.